Good morning, traders, and welcome to BCR's morning market outlook for today. So, taking a look at the dollar index first, the US dollar index moved back above the $100 level as markets reacted to the Federal Reserve holding interest rates steady. Policymakers emphasized that inflation risks remain elevated while also noting uncertainty around the economic impact of the ongoing Iran conflict. Although the Fed still signals limited rate cuts ahead, the timing remains unclear, with markets leaning toward late year easing. In the background, geopolitical developments continue to shape the sentiment. Fluctuations in oil prices have influenced safe haven demand, with some capital rotating back into risk assets during temporary price pullbacks. Even so, the dollar remains relatively resilient, consolidating near recent highs after retreating slightly from last week's peak. Momentum remains supportive in the short term, though markets are cautious ahead of clearer policy signals. Next, let's take a look at WTI. Oil prices remain elevated as geopolitical tensions in the Middle East continue to drive supply concerns. Disruptions linked to Iran, along with instability around key transit routes like the Strait of Hormuz, have heightened fears of constrained global supply. Attacks affecting export infrastructure and shipping have added to uncertainty, while partial disruptions at major hubs have reinforced concerns about ongoing flow constraints. Prices have risen sharply, up more than 40% from pre-conflict levels after breaking above $100 and briefly pushing past 110. They are now fluctuating in a high range, reflecting both supply risk and shifting expectations. In the short term, markets are likely to remain highly reactive to headlines, with any further escalation capable of triggering sharp price spikes. Over the medium term, the trajectory will depend on whether the conflict stabilizes or extends, with prolonged disruption likely to keep prices structurally elevated and increase pressure on the global economy. Spot gold. Gold prices moved lower despite heightened geopolitical tensions, as stronger US yields and a firm dollar reduced the metal's appeal. The Fed's cautious stance on inflation and its signal of limited rate cuts have increased the opportunity cost of holding non yielding assets like gold, offsetting its traditional safe haven role. While geopolitical risks, particularly in the Middle East, continue to offer underlying support, monetary policy remains the dominant driver. Technically, gold is showing signs of short term weakness, with momentum indicators pointing to a softer bias. However, key support levels remain intact, and price action is likely to stay sensitive to shifts in rate expectations and incoming signals from the Fed. Taking a look at the AUD-USD pair, the Australian dollar strengthened after the Reserve Bank of Australia raised its cash rate to 4.1%, in line with expectations. However, the narrow margin in the decision highlights growing disagreement within the central bank on the need for further tightening. Policymakers signaled a data dependent approach, reflecting uncertainty around how restrictive current settings already are. Following the decision, the currency initially showed mixed movement before gaining ground as broader risk sentiment improved. As a commodity linked currency, the Australian dollar remains closely tied to global demand conditions and energy prices. While rising fuel costs may support inflation expectations and justify tighter policy, they also introduce uncertainty that could weigh on growth. In the near term, the currency's direction will depend on incoming economic data, inflation trends, and shifts in global risk appetite. That's all for this morning's market analysis, and I'll see you in the afternoon review.